I've got her trying to build up a little video with our little bouncing heads.
All right, cool. I think we're live. Andy, bouncing heads live on Facebook. Here we go. So we're live, mate. Welcome. Another Wine and Wisdom on a Friday.
No juice here.
No juice this time. Good to see you back on the decent juice, my friend. The grape juice from the gods, which is the good stuff. So, mate, good to see your smiling, lovely face once again on a Friday. We were playing telephone tag, gang, Andy and I, all week, and we can count on Wine and Wisdom to be around about 5 o'clock with a wine to catch up anyway. But there you go. So, mate, welcome along. Quick intro for those who are joining us for the first time. Andy Fenton, Jason Witten, my name, and on Fridays we've been getting together for the last 3 or 4 months and having what we're calling Wine and Wisdom. 6 months. Wow, okay, that's fantastic. Wow, time flies when you're having awesome fun, Andy.
Our anniversary, Jason.
Oh, mate, we should send each other gifts. That's the way. But yeah, for those who are listening in, Andy, all things share market, banking, and the world of stock markets around the world, and myself in the real estate game, both of us over 20 odd years. We get together on a Friday, talk about our respective worlds of expertise, influence, and interest, and pontificate, and maybe sometimes share a little bit of wisdom from our experiences and our opinions. Opinions is probably not a very good word, actually. Our understandings and learnings from our industries, and hopefully people can take something away on a Friday night of value, even if it's not a laugh or two, but hopefully it's a little bit more than that. But welcome, everyone. Welcome, everyone. Glad to have you all here.
As long as it's not what Trump says, alternative facts. The alternative fact.
So is that what he's calling it these days? The alternative facts, huh?
I've forgotten her name. I think it was Jessica, who was one of his main runners there with him, has been with him for a long period of time, and the daughter threatened to excommunicate the family if they continued to run with Trump. But her famous line for defending, because she was a staunch defender of Trump right the way through it, and we've gone, are you a little bit astounded by Donald's lack of understanding of what facts are and the real truth in things? She said, well, what you don't understand is, Donald actually understands, that the alternative fact.
That's quite funny. Well, there you go, mate. Well, listen, while everyone's sort of jumping on board, a few people online now, mate, I thought we'd have a bit of a talk about what's in the news. It's been an interesting last couple of weeks, and plenty of things coming out, certainly in the share market and the stock market, mate. But why don't you kick it off this week? You've got some stuff that what's in the news? I don't know. Do we do a drum roll? What's in the news this week, Andy, when it comes to the equities market, the stock market? Hey, what have we got to be aware of as investors? What's going on?
Well, mate, recapping to last week, because we made a few big calls last week. We were talking about we talked about big business, small business, the difference between selling a small to medium business and what are they worth, and the difference between valuing a large business.
Yeah.
So we made a couple of quick calls on there because it was timely, because Tesla and Apple had just done a share split to make their shares more affordable. And I said, without giving advice behind it, and picked it to the nose. Picked it to the nose? Pick the nose. Pick the nose on it, Jace. Pick the nose on it.
Pick it on the nose. Yep.
I thought that the stocks would rally quite heavily based on just people being able to get into them. But I sort of made the call, get in, get out pretty quickly. So, mate, we'll just jump over here. So this is Apple in the Friday, which is that 31st, I think, of August. So the Friday through to the share split there. So a whopping 10%. So hit it on the nose. And when I said, if you are in, you might want to get out quick. Well, yeah, you wanted to get out pretty bloody quickly, because it wiped off a fair bit straight afterwards. So
wow, there you go.
I'll go through and have a little bit of a chat about what actually happened there. And And then the same thing with our brothers over at Tesla, our brother from another mother, and Elon Musk, which we'll chat about as well a little bit later on. Elon Musk, the third richest man in the world, just took over from Mark Zuckerberg because of this rally up. So Tesla's been just a huge growth story for a long period of time. But again, a similar sort of a chart here, and you can see, so this was a 14% kicker, not a bad job for, 2 or 3 days worth of work. But you had to get out pretty bloody quickly because that's what it looked like afterwards. And if I move my fat head, this sort of leads into what we're going to chat about. So Elon Musk, I don't know whether this is 100% true yet, but it could be an alternative fact.
Could yeah, all right. Tell us an alternative fact, Andy.
It could be an alternative fact. Oh, geez, I don't know how I've done that. It could be an alternative fact, but Elon Musk actually took over from Mark Zuckerberg as the third richest man in the world, as Tesla just went flying on the stock market, absolutely flying. It's been a meteoric rise, and we've talked about it a lot here. But just last night, which I'm going to chat about a little bit in a few seconds, the US market had a pretty big downturn, and Tesla, although we picked up 15% up on the share split, it's down a whopping 10%, pretty much in a day and a half's trade. So I think that there's a good possibility that Mr. Musk is pretty much gone up in smoke. But where'd he go? There he is.
Yeah,
there he is. So he had his run as the third, and I think he might be back behind Mark now, but still pretty good position, one would say.
Not a bad position, yes, absolutely.
But if you have to lose, going from second richest to third richest, or third richest to fourth richest man in the world or person in the world, it's a pretty reasonable race, isn't it? Either which way, I wouldn't mind losing that one.
Exactly.
So this is the big talking point. This is the biggest market move. Oh, that's beautiful too. That's it's good to be back on the grape juice. It's just before we go on. This is an old friend of ours, and it's an old friend of ours, Jace.
Have to go in a bit further. There we go. Yeah.
The old Sally's Paddock, or Sally's Paddock from
Hill.
Sally's Hill.
Yeah.
It's a little cracker drop down from there. Got that sent over. It arrived right in the middle of my cleanse, which was taunting the devil. And
when's this cleanse over?
It was just staring at me. And what a wonderful drop it is. One of Victoria's beautiful wines. But I digress. So the run had to finish at some point in time, and there's a lot of interesting points here. But Dow Jones and the S&P all down, the Nasdaq all down. Nasdaq down 4.9%, almost a whopping 5%. Just alone to contextualize this. So Apple in a day's trade, one day, and the futures have fallen since. So the futures, which is the aftermarket, they're still falling at the moment. So it's going to be really interesting Monday, right? Great opportunity, maybe. But Apple fell off a whopping $180 billion, single day's trade, $180 billion in one day's trade. So let's put that into context. That is the size of Cisco. That's like Cisco being here one day and gone tomorrow. That's like McDonald's. And that's like the Big Mac being here one day and the Big Mac gone.
Wow.
No more Super Size Me. Gone. And here's one for the alternative investors out there. This is the entire size of the total market capitalization of Bitcoin in a single day's trade.
Wow. You just don't realize how big that company is. And mate, that's mind-blowing. That's mind-blowing.
Incredible, right? And so here's the thing. And so a lot of people won't know what the various different parts of this are. The S&P 500 is basically a representation of the top 500 stocks in the US. Doesn't matter what industry, but the Dow Jones Industrial and the NASDAQ, they have a different composition to them. The NASDAQ has all of the tech stocks in there. Right, so this was a very specific sell-off. So this was big sell-offs across the big tech stock names. But here's the thing. And that's what drove markets, right? That's what absolutely drove markets. I haven't done the graph yet, and I need to do it. I keep promising to do it, but I don't. So it may be done one day, or it may not. But the tech stocks ultimately have driven the American market. So I reckon if you strip them out, the market might be flat or down.
Yeah.
Right? That's how big these giant caps are. So the NASDAQ down a whopping 5% or just short of 5%, which is absolutely incredible. But here's the thing. Ralph Lauren up 5%. Royal Cruises up 4 or 5%. Financials had a big rally on the same day. Big rallies, like big rallies. And the market's still whopping down based on these tech stocks. So you've got to start to look at a bit of opportunity, and there's a real theme here.
Totally. Yeah.
And this is an interesting one for our old domestic friends. Now, we spoke about this a little while ago. I don't know whether it was on Wine and Wisdom, but there are a lot of big names that you and I know who are very, very well known, very well connected money that put a lot of money into Myer about 12 months ago. And we were thinking, why? Why would you put your money into a sinking ship? So it's just actually come out. So Myer and Amazon have struck up a deal now, so you can actually get all of your Myers.
Isn't that called insider trading, Andy? Andy, isn't that called insider trading?
Mate, look, I thought it was interesting that they'd put all of this money into the company. I wouldn't allege that, but it wouldn't be a big leap to make. But it is very interesting. One might say that they jumped in order to position the company for a strategic move like that.
Yes.
So effectively, very soon, if not already, 21 Myer stores across New South Wales, Victoria and Queensland, you will be pickup points midweek. There's plans to expand the Amazon hub into further Myer stores, including regional areas in time for Christmas. So this is a really interesting, this goes back to what we talked about at the very beginning of Wine and Wisdom as well, is that this time of potentially great adversity and less about digital disruption, but the change of consumer habits and the change of consumer psychology, this potentially is an incredibly brilliant joint venture, because it's not just how do we sell more product. This is a logistics operation.
Logistics, you get right. It's about like distribution and logistics. You know, Myer's got the shop, Amazon's got the sales and the product. Let's do a joint venture. It's so smart. I love this stuff because, Andy, you know, you and I chatted about this, you know, where the world of our stock world and our real estate world, you know, converge, and it's in that logistics center. It's in that data center. It's in that storage center, right? Like they have to have, eventually these big businesses have to have some physical presence somewhere, somehow. And this is, that's so smart.
Incredible. Like I think that the press really haven't picked up how clever this is yet. At the moment, it's being bandied around town as the big boy on the block comes in for a takeover and stuff like that, but they haven't really pulled it apart.
Yeah.
And I think there's some true genius in this strategic positioning, and who knows, might be an acquisition for down the track. It probably doesn't need to be. You know, it's a win-win for both companies, and an incredible example of how two businesses can come together, not for specifically the purposes of what they do, but from the strengths and weaknesses of each of them. And let's face it, Amazon has got a growing brand name in Australia, and everyone knows Amazon as far as Amazon and America, and it's always Amazon America. And now more and more people are buying on Amazon, but Amazon's stats in Australia aren't great. They're well behind Bezos and the team's forecasts of what they do in Australia. They've actually struggled in Australia. So this is also what we call, oh, Jesus, I've just lost it. Brand, shit, help me out, Jason. Leveraging off somebody else's brand.
Brand, I don't know, brand ownership, mate. You know,
brand recognition.
Recognition. I mean, at the end of the day, online purchasing right now, you know, really at the end of the day, you know, COVID for certain businesses has been an extreme gift in this space. You know, like it has brought forward, you know, 5, 6, 10 years worth of, you know, let's wait till it integrates to absolute, there's no choice. You have to integrate, you know, you have to integrate. You know, the 70-year-old, the 80-year-old person is now shopping online for the first time ever, and you know, that's awesome, and I love that. And a quick shout out while we have a little gap there, Andy. Quick shout out to everyone online. Great for you guys joining us. Thanks for being here. Hey, if you've got any questions for Andy and I as we go through, we're just going to sort of, just going to sort of debrief the news and what's sort of out in the marketplace for the first part of tonight. But if you've got any questions, chuck them in the chat. We'll circle around and answer those questions as we go as well. And Andy, I've got a couple of people who chucked out alignment or third-party recognition. Which one were you looking for? I don't know.
I've got a complete mind blank, but it's the name of when you're borrowing other people's brands and leveraging off them.
Oh yeah.
Two dyslexics in a row.
Borrowed credibility. It's like you're borrowing Myers or what's the name's credibility in that local community, and you're riding on the back of that that business, that shop. It's been there for 30 years, and now Amazon just borrows the credibility, the whole social presence. Boom, just jump in. Yeah.
And think about it from the perspective of, your 50 or your 40-year-olds who aren't adopting and are a bit more traditional through to your 70, 80, 90. Myers is a staple. Like, remember that those who are sort of 60 to 90, they used to go to Myers and David Jones to have, Devonshire tea and high tea and go shopping and have.
I remember doing that with Shay. Like we went there for tea and a scone.
And so they're borrowing that brand loyalty. They're borrowing that brand loyalty. And God, just an incredibly smart move. Logistically, brand perspective, I reckon it's going to be an example of how two companies can come together, and it's a total mutual symbiosis that'll see things run off the charts. So nice. Clever moves, and it'll be really interesting to see what happens with these guys moving forward. Really interesting.
Mate, I like it.
The last one, and I've got a theme for the investors and the retirees out there later on called. Because in the news also more recently, not so much Australian, but globally in the investment community, is the thing called the death of the 60-40, which I'll talk about later on throughout this. And it's the death of 60%, equities and property, 40% fixed interest. And they're going, is this the death of the 60-40? Because fixed interest is doing nothing. And I'm going to talk about examples later on. And we're thinking about that a lot with our client portfolios at the moment, because we've got to start to get really smart about how we do it. So we'll chat about that later on, but this plays right into it. So why do you think I couldn't find a knife with blood on it? I Googled Dexter and Westpac, but there wasn't any link there. But mate, what do you reckon I've got the knife and Westpac for?
Mate, I reckon they're cutting something. Are they cutting dividends?
Well, yeah. The answer to that is definitely yes. What else?
Mate, what else? Are they being stabbed in the back by their industry, the banking community? I don't know. What's going on?
It's taken a knife to its deposit accounts, cutting saving rates by another 15 basis points. 15 basis points, right? 0.1% doesn't sound too much, but 16 basis points in an environment, that's almost a 20, 30% hit on where they're currently at. Now, I don't know, did I miss an RBA notice, Jace? Did RBA cut rates?
No, I didn't see that come out.
I didn't see that either.
If anyone's listening in,
So they've just done that. They've done that without an RBA cut. So that's a move to bolster up the balance sheet. So interesting that the NAB CEO last week came out with some outrageous, egregious even comments in around.
We had a chat about that, didn't we?
And now Westpac have come out. So it's clear that the banks are starting to bolster themselves up. So consumers,
the reality is, Andy, like, anyone who is paying attention to their cash, and if it's sitting in a bank account, like both you and I know, it's going backwards. Cash is trash. It's devaluing. I was just telling a few of the crew in the last couple of days. I had the pleasure of sitting in on a meeting a couple of days ago, and I was in on a meeting, a board meeting of a company that manages over $1 billion worth of private family funds, and they were looking for deals. They basically said, listen, we've got 300, 400, 500 million in cash. It's literally going backwards compared to inflation. No one's giving us a good deal. Our charter is to make sure we're getting 8, 9, 10, 12% on this cash. And the family offices are like, down our throats about it. Like, what do you got? Have you got a deal? You got something that can make me some money? Pitch it to me. I want to know. I want to know. And it's amazing what reminded me. I called it the $1 billion reminder in one of my lives the other day. It just reminded me that, if we're all sitting here, and certainly for you guys in Melbourne, COVID lockdown, we're all like, oh shit, the world's ended. Woe is me, Dan Andrews a dickhead. It's not the lockdown's not going to end till fucking Christmas or whatever. But if I'm not trying to diminish that experience, but what I'm saying is, if you get caught up in that spiral, which is a downward spiral, it can be a real cluster, and you can miss out on shit like this. That's the first time that I've ever been invited to sit at the table of someone who's in charge of $1 billion. And that wouldn't have happened for me if COVID wasn't here. Right. Well, maybe it would have, but for me on the flip side, there is so much opportunity in that space. Cash is devalued. The banks are slashing returns on deposits. Money is looking for deals. Money wants to go to work. Money's trying to find a place to get a return. For those who are in, if anyone's got a good idea or a good deal out and about in the world, now's an amazing time to be searching for money, right? Anyway, like that's what I thought anyway. So, again, the banks are probably going to facilitate that in a negative way, really, at the end of the day.
Mate, absolutely. Look, they're going to play their critical role in the economy. And as a consumer, it's, you suck it and you see. If you're at their peril, you are at their peril. If you utilize them as an intermediary, then wonderful. You then look elsewhere for your sources of funding. And but ultimately, banks need to remain a viable option, and they need to remain profitable. And because we don't want them not to be profitable, because that's the worst case scenario. So we might take the piss out of them, but it does buy into and what we'll discuss later is where do we invest now, and where should we be thinking about, and where should we be trying to ask our super funds and things like that to go in times like these? Because I've got some crackers to share with you later on about retail funds and industry funds.
Well, it's an interesting one, we do. And to be honest, like I've been a bank basher for almost 20 years, really pissed me off. From a property point of view, they really give me the shits. But, they have stepped up in COVID times. By and large, they have done their job. They have protected the general consumer. They've done what they've needed to do at the cost of their share price and, their shareholders and stuff like that. And, I think that's a testament to the good. When the tough times come, Aussies, stick together. You know what I mean? And which I think's fantastic. But at the end of the day, they've got to get back to work. They've got to get back to business. They've got to get back to sort of creating returns for shareholders, and that's probably one of the moves that they're trying to sort of bolster the balance sheet and make sure we don't lose AAA ratings and all sorts of shit that's going on in the background that none of us, every day sort of really appreciate. The knock-on effect of that, maybe in a year, 2 years time, for Australia and our credit ratings and stuff like that. So
yeah, it can make it very, very tough, but it's the stuff that people don't see. And but let's not defend them too much. It's too much fun to bash them, because you're either a bank basher or you're a banker wanker. So it's one of the two, right?
Well, I've been on both sides. Banker wanker over there to a bank basher here. No, we can get into it, mate. That's for sure. But hey, listen, in the news for me, some pretty interesting things. Melbourne's had a bit of a tough time, lockdown, second lockdown. It psychologically and economically, the first lockdown for me as a property investor really, was to be honest, quite a breeze. It wasn't that impactful. The second lockdown has actually really, really rocked, lots of people, lots of renters, lots of owners. It's having a way more significant impact than the first lockdown, mentally, emotionally, financially right now. So, shout out to everyone in Melbourne, hang in there. We're here for you. If you need me or Andy to give you a hand, give us a shout out. Yeah. Give us a shout out. But, on the flip side, some really cool things going on. There's already a plan, a recovery plan being fast tracked for Melbourne, $104 billion recovery plan for Melbourne CBD. So that's kind of cool. So what happens, when there's a downside, the governments, chip in, everyone's chipping in to get a bit of an upside. I'd love to see, and I'm quite bullish about Melbourne, always have been for a good decade. I think it's an amazing city. I think it's going to be the best city Australia's got to offer, for all sorts of reasons. Certainly when it comes to property investing and the economy. But listen, there's going to be money stimulate that economy down in Melbourne. And for those who are feeling the pinch right now, there's plans afoot underlying right now to reinvigorate the city, reinvigorate the economy. So, don't despair. The government's not leaving you guys off the radar, and matter of fact, putting the Melbourne economy back at number one on the radar, because it is the most affected right now in the country.
It'll be interesting to see more detail around that as well as it comes out, because, it's one thing to pump the JobKeeper and JobSeeker payments and keep them going, but ultimately that's a Band-Aid solution. It's putting a Band-Aid on an artery, on an artery cut.
Yeah.
You need to start to either figure out ways of being able to stop it or put more blood into the system. And that analogy, being gross, is the economy. So if they can put $108 billion back into the working, it might take a year or two to flow through, but it will flow through. And then the kick you will see on the back of that will be extraordinary, which we've seen time and time again.
It's a bit of a delayed effect, actually. Interesting. This one, I was gonna jump to that other thing first, but on the back of that comment, Andy, this is interesting going around. And again, shout out to Timmy Boyle, our main man, provider of good data. Timmy Boyle, if you're listening in, mate, this is all you. But right now, unfortunately, the government's been handing out cash. My business partner, Semi Saggers, calls it the government's been spending cash like a bunch of drunken sailors on shore leave. And,
and what do we do with the drunken sailor?
we put him in the cell for him to sober up. But, this just came out just recently that Aussies have been banking the cash. They've been saying, thanks, I'll put it in the bank account and I won't spend it. The point often with stimulus and cash injections is the hope that, people will take that money and go, you beauty, I'll buy myself a new television. You beauty, I'll get out and about and go for it. Right. So,
but what a flawed thinking though. If Australians do that right now, where's it going? It's going to Netflix. It's going to Amazon. It's largely going offshore.
Yeah.
And I reckon, mate, the reason why that's up at 20, I reckon a lot of people have been tuning into Wine and Wisdom, maybe more than what we know about, and have been listening.
Tell them, bank it away, put it away for a rainy day, because the rainy day's coming. It's not here yet.
and you don't want to see the instantaneous effect. This idea of and I think it's just politicians being politicians. They say, unless it doesn't have an immediate effect, it's useless. But ultimately, the storage of that to keep you on track, to keep the business on track, to keep a few more people employed for a longer period of time, to allow 100%. You to get through a longer process is really what we want to see. And to me, this idea of flash cash is just horseshit. It really is. It's
It's
just
true.
it's just a quick gratification. It's just a quick hit, and then we're just straight back in it.
No, it dead right. And you can see there, December 8th, that was the early impact of the GFC. It played out in 2009, 2010, but same sort of deal where people sort of started to save more than spend more. It's an interesting gig, but that one. It's a telling thing where people start to store the cash. And for me, Andy, what I like the idea of this thing is sometime in the next 2 or 3 years where there's confidence, where people have got their jobs back, where things feel whatever normal feels like again. That's when we'll see that cash flow back into the system. That's for you and me, 2 or 3 years time is not a long time as an investor. It's not a long time. I'm buying properties right now, expecting in 3 to 5 years time, there's going to be some very positive upswings from these moments in time. And so, for those listening in, that's your job as an investor to look out into the future. Right now, I am as fucking happy as Larry that both Tesla and Apple have dropped in prices. Because Andy, the reason I was actually calling you for about 10 times in the last 2 days is I wanted, and full disclosure, gang, I'm not a share guy. Andy's a share guy, and for me, I've always wanted to buy Apple shares. I've always wanted to have some shares, but I don't have any. And right now, I want to set up an account and buy some shares. So Andy, I think it'd be kind of cool, gang, and maybe for those listening in. I'm going to publish my reports or my returns on me buying some direct shares and having a bit of a punt. I think I might do something like I'm thinking $1,000 a week, Andy, or $2,000 a week. I'll invest over the next 12 months. Everybody, let me know if you think that'd be kind of cool. And let's pontificate and let's put our money where our mouth is. I'm happy to chuck a couple of bucks in there and have a crack at it. Andy, you can give me some guidance and coaching on how to go about it, because
You reckon it'll be the first funds into the green energy investing fund, will it?
hey, I'm in. Let's do it. On Monday, but you got to tell me on Monday I want to own Tesla and I want to own Apple. It's the cheapest time in a long while to do it.
let's see what the futures do over the weekend.
All right.
Because it could be a great opportunity, but let's just face it. Apple was just tipped into $1 trillion market valuation. I'm more bullish on Tesla than I am Apple. I like Apple more than I do Tesla, so it's a hard thing to say.
I love both of them, mate.
I love them both.
I'm a fanatic, so even if I lost money, I'd still love them both.
I love both of them. And I think they're both, but what I'm saying is I favor Tesla a little bit more than Apple.
Yes.
And it's because of its cult nature and because of its 20-year vision. Tesla has a 20-year vision. Apple doesn't have that 20-year vision anymore.
Yeah.
Apple had that 20-year vision 20 years ago.
Yeah, dead right. You're dead right, Andy. You're dead right. I was a convert 15 years ago, and there you go. I was talked out of buying Apple ages ago by an advisor, and I'm actually spewing about that. I should have bought it, but anyway, mate.
What do you reckon if you bought Apple from the day it listed? What do you reckon it returned on average till pretty much today?
Oh shit, I don't know.
Because yesterday was Apple's birthday of its stock market launch. I think I'm pretty sure it was. Anyway.
No, really.
Yeah, pretty sure. Pretty close to it.
Mate, put me out of my misery.
Just give me a ballpark. What do you reckon? If you just invested, 100 grand, what do you reckon was the annualized return every year? How much did you make?
I don't know, 30%.
It's high. It's at 20% per annum every single year since the stock launched. It was 1980. So when I was one, it's done 20%.
What would that $100,000 be worth now?
A lot.
Unreal. I was doing this math the other day because I was talking about Westfields. You know Westfields.
Yep.
What's the name? Lowy, Frank Lowy. So if you invested $1,000 in 1959, I think it started 1959, 1969.
That was a year after you were born, wasn't it?
I'm not that old, mate. But I need to tune up my Zoom filters here. I need to dial them up a bit more.
We need to get Tony back in here for this one.
Yeah, $1,000 was worth $1.4 million 30 years later. So it was 30 years. So yeah, 79. I think it was 79. So, you know, mate, huge, absolutely huge in that sort of space. It's compounding.
Well,
yeah, totally.
Here we go. As I actually Googled that about Apple, mate, you won't believe it. It was actually in the Apple filters. Sorry, it was in the Google filters. So let me see here.
Mate, they were listening into your and my conversation, and then they prepaid for that to be positioned right there, so you could see it, Andy.
So if you had $1,000 and you invested it, the investment would be $1.3 million.
How much?
$1.3 million.
There you go. Crazy, huh?
It's an incredible stats, actually. I'm going to save that page for later.
I love it.
That was a quick read. Don't quote me on it, but just I just did a quick read, and I'm dyslexic, so it could have been $0.00001.
Well, I'm pumped, mate. I'm pumped to get into the equities market, and I've always thought that at some point in my investing world, I would like to get my equities, equities.
Let's see. Give us a thumbs up if you reckon it's a good idea for Jason to have a punt. And look, I'll join you on the punt and see what we can do. Just hit the like button or hit the old love button and
give us a like or love. I'm gonna invest $1,000. I'm gonna invest $1,000 every one in wisdom in a bit of a idea. First two are going to be Tesla and Apple. So I'm in. We're gonna go for it. We've got a few people who like the idea, Andy.
Yeah, there's a couple coming through. I thought it would have been bombs on the page, but let's see it, mate. I reckon it's a great idea. I reckon it's actually a great idea. We'll create we'll call it the future portfolio or something like that.
Bit of a challenge chucked out there. My darling wife wants to compete with me and see if she can do better in the stock market. All right, darling. Yeah, Shay's a bit of an accumulator. She's quite a good investor. So I think that would be super cool, darling. So let's do it together for sure. Mate, here's one thing in my neck of the woods. Certainly from a property point of view, a lot of investors, you know, the property market, well, the general economy in general in Australia has been over the last 30 or 40 years, boosted by international migration into Australia, immigration into Australia. I mean, really, the stats show that Australians aren't having enough babies. Our natural population increase has decreased over the last 30, 40 years. And, the government's economic policy has been, we need more taxpayers. Our average demographic has been getting older. We're producing less children. So really, to keep the taxpayer base growing in Australia, we need people, and we need people who actually go to work and pay taxes. And so, that's been a very aggressive policy of the government, over the last 20 or 30 years. But here's the update. Obviously right now in the middle of COVID, no one's going anywhere. No one's coming in. No one's going out. Immigration has, come to a standstill. But here's something that popped up the other day, which I think, I was making a call on this ages ago. The government will catch up. The government has to catch up. And one of their new policies, they're calling it the super talent. Targeting from overseas. They're going to target super talent, and they're going to target people with money, basically. Whether that's a good strategy or a bad strategy, Andy, we're yet to see. But
let me ask you this. If they're going to compromise and they're going to go, you can come in if you've only got one of the two, which one do you reckon they're going to favour?
They'll favour money for sure, because the Australian government likes people who come to Australia and buy a house, because they know if someone buys a house, that has a trickle effect in our economy. I mean, I think it's flawed personally. I benefit from it. I benefit from a very one-eyed economic decision-making process, as a property guy. Right now, right now. Like I quite like it for myself personally, but I don't think it's great for long-term stability of the country. I think the government should invest in some other things as well. But let's call the spade a spade. They know what works in Australia, so they're going to stick with it. If it's not broken, let's not. We don't have to fix it, right?
But I think that's hysterical. It's kind of the exact reverse of the United States, right? Whenever you think of the United States, what's the one thing that sort of typifies the United States?
Mate, businesses, right? Like the entrepreneur. Yeah, there you go.
The Statue of Liberty, right? So remember the old state: bring you tired, bring you hungry, bring you poor. So what is Australia doing? Bring you rich, bring you stupid, and bring the smart people with you. Kind of the exact opposite.
That's the exact opposite. Well, we could go down a rabbit hole there, Andy, I think, at the end of the day. But we won't. I'm just having a laugh.
I think it's reasonable policy, but it's hilarious when you compare it, because you and I have talked a fair bit about comparing COVID with World War II as far economically, not, and I don't want to upset people, but from an economic perspective, is in where have we seen the world in similar places before? Well, World War II with all of these trade barriers, and a slightly different approach to policy than probably what was adopted post-war times. But hell, we're Australia and we're a long way away.
We'll see. Well, mate, this one might be you might want to sort of weigh in here, but Warren Buffett, he's making some investments, and $8 billion of investments per se. That gives him some exposure. Really, if this smart man's going to put some money indirectly or directly into Australia, we've got to maybe take sort of heed that, it's not a bad bet. He's seeing our economy as a good long-term stable investment. He hasn't got it wrong many times in the past, Andy.
He's got it wrong, probably 40% of the time, and he's got it right 60%. But
we've got a 60-40 chance, gang. Let's do it.
it comes in, but that's an incredible statistics in managing money. That's good odds if you can do that. And look, his model has always been one of value and buying cheap assets. And in order to buy a cheap asset, you have to be able to figure out what the forward-looking cash flows are on these suckers. And so when you look at mining, definitely. Short term, whenever you see a suppression in mining assets, the world will continue. Precious earths, precious metals, iPhones need components, and that comes from precious earths and precious metals. We need steel to build buildings. We need all of these sorts of things, and we dig it up and we ship it out here in Australia, and that's what we do. And Africa isn't quite ready to be online yet to be able to do the same thing. So that sector has been largely smashed. And some of the things that I've been saying to a number of clients more recently is because we've had big pickups in the tech industry offshore, like huge, astronomical, ridiculous, and wonderful at the same time. But the lagging stocks are the financials, are the energy, are the mining and resources. And those guys will come back into vogue, but not based on hype and future vision and future growth. And I love Elon Musk, I love future vision, but they will come back based on fundamentals of there will be X amount of money put into the bank, and eventually there'll be price rationalization, and you'll see 30, 40% uplift. And that's a good 10% yield for the next 3 years. And if you can hit 10%.
Yeah, well, I mean, I was listening to something the other day, and Elon Musk, there was an interview with Elon Musk, and basically, I'll grab it and I'll tag you, Andy. Basically, he said, listen, here's a shout out to every mining company in the world. There's not enough nickel. Can someone just mine some more nickel? Because I'm making a lot of batteries. And he basically said on the interview, listen, I'll give you a 20-year contract on all your nickel. Just somebody let me know if anyone's got any nickel out there. Like, it was like crazy. And as soon as I heard that, it was a podcast, and I'm like, I'm going to buy some nickel mining companies. Where are they?
Well, let's throw a little bit at the speckies on the old nickel stage now, and that statement's true, but that's going to take some time to filter through. That's the reality. Because Elon Musk he doesn't look to tomorrow; he looks to 30 years, and that's his short-term vision.
30-year plan. Yeah.
His long-term vision is probably 150, 200 years from now.
He'll be still alive. He's putting anodes in his brain, which is fucking crazy. But anyway, they got something different. Here's something that I quite like. In the world of my world, talking about affordability, household interest payments relative to disposable income. It's actually cheaper today in relative terms to have a mortgage on average across Australia. It's cheaper today than it was 20 years ago. So the disposable income based on the average house price and the interest rate as of today, because the interest rates are so low, and I don't think they're coming up anytime soon, that the disposable income is the lowest in 20 odd years in comparison. So it's interesting things like, from a property person's point of view, supply chains are stuffed. In my world, if you have a look at this one, we've been talking about this for ages. Apartment supply to dry up over the next 3 years. I've been talking about that. Like for yonks. And here's something that's really interesting. This is the Brisbane apartment supply chain. Have a look at how many properties from 5,000 to approved this financial year, 300. So the drop is massive in the supply chain. And this is reflected in places like Melbourne, places like Sydney, also places like Perth, the major centres, the major cities. They have these supply chain issues right now in the real estate game, which is pretty crazy. Like we're looking here, this is the Brisbane Residential Construction Index. We're going to be at literally nothing, absolutely bugger all properties being completed in 2021, 2022. And here's Melbourne, Andy. We're right now at we're actually not too bad. The supply has actually been pretty good in Melbourne, and it actually was still quite a bit undersupplied compared to the population growth of Melbourne, because Melbourne was really growing extensively. But now the early data of approvals sees that supply chain dropping insanely low by 2021, 2022. It's going to be really interesting. I'm quite excited about the idea,
On that basis, and I know nothing about property, resi anyway. So on that basis, though, I'm going to make a wild accusation, I'm going to throw it out there. I'm going to throw the dart at the dartboard blind. And I'm going to say that in 2023, we're going to have an absolute boom in Melbourne property. And the reason why I'm going to say that has got nothing to do with any fundamentals. It's got nothing to do with knowing anything about property. It's because every bastard is going to go up to Queensland and live there for 2 years and then go, you know what, it's too bloody hot, too bloody sticky. You got to get back down to Melbourne and watch some sports. And they'll come back. And as they come flooding back over the border, prices are going to go through the roof. I'm not sure if it's
that's as good as prediction as any, mate. To be honest, like, I moved up to the Gold Coast from Sydney, and I'm like, it's too bloody hot here. I think I'd prefer to go back to Sydney. You're dead right. You know what I reckon will happen? They'll go, well, maybe we'll leave our property in Brisbane as a rental, and I'll go back to Melbourne for better coffee, better sport, better food, better city. So I'm with you. I think there's a version of that in there, because there's been reports, 22,000 interstate migration, 22,000, one of the largest Southeast Queensland migrations in the last 10 years, in the last 6 months, from literally Melbourne and Sydney to Southeast Queensland.
What are you going to do, mate? What are you Queenslanders going to do with all of the dickheads that are now infesting your beautiful state? You're going to end up with a whole lot of us Victorians.
Queenslanders continue, like they go further north. So what happens is, like, Brisbane, that's too. I'll go to Sunny Coast. Next one. You keep going, right? Like, so we've got probably another 30, 40 years. We'll keep going until we run out of space. But anyway,
state of origin is going to be outrageous. It's going to be 50-50 in a Queensland pub. That can't be allowed.
Mate, it's crazy, mate. Mate, here's one right over your passion, Hidden Plate, about REITs, real estate investment trusts. This is literally around the corner from our office in Sydney, and I've said to you and a number of people before, we have no interest in going back into an office. Positive, we've handed in our lease. Our lease in Sydney ends in October. We're on month to month on our lease in Melbourne. We'll probably hand that in as soon as we get ourselves organised logistically properly after the lockdown and bits and pieces. We've handed in our lease in Brisbane. Mate, we've got no interest in going back. And, this is what is out and about. My business partner, Sammy Saggers, has been watching this, like a hawk in Sydney, North Sydney, Crow's Nest, where our office is. Literally a 50% drop in rent from, or close enough to 50 anyway, 45% drop in rent. And, this is what's going on in those commercial buildings. And you and I have seen, logistics, industrial buildings, go up 20 or 30%. And the commercial world, we're seeing this interesting stuff, go down 30, 40, close to 50%. And, this is one thing, over in your neck of the woods, Andy, which REITs are exposed in this way, and, something maybe for next week, potentially, that you could bring a little bit of wisdom to investors to, the mix might be, there might be some great industrial properties, but the commercial ones bring the returns down and really affect people's, share values and their wealth,
Well, you know what, and I think it's a great topic, and it's a really interesting one. What's been happening in this sector, and I haven't seen it, it's starting to be called more generally, but what I think is going to happen is you're just going to see greater segregation. So it's no longer commercial property. It's no longer commercial industrial. It's now commercial industrial logistical. And eventually it's just commercial property is just going to be a thing of the past. It's going to be, boom, that term's going to go. And it'll be, what are you in? I'm in logistics. I'm in logistical property. What are you in? I'm in industrial property. What are you in? I'm in shopfront property. It's going to change because the segregation is too big. It used to be that you could invest in commercial property because if you diversified across those, it was fine. But now, no. And mate, I got some gems in there. We've got some very good friends in wonderful places, and one or two in companies that are doing it better than the others. And if you want to know who's doing it better than every other company in Australia, look at the A-REITs index, and you'll see who's doing it the best in town. And you'll see the ones that aren't doing it well as well. And I'm not going to name them out because I don't want to get sued, but you'll be able to see who's doing well and who's not. And then all you need to do is have a look at their portfolio and understand why. But that's a great point. But the other side of that, and this comes back into resi, is that where we both agree about commercial and resi is that properties with great lease terms and great tenants don't get 50% declines in rent.
Yeah. And
management is when it comes to commercial, and I'm assuming in resi as well, management
100%.
and purpose of property is so critically important. And if you're a fly by the seat of your pants, think that you know everything because an industry is going up and it's just, let's just get in because it's just on. It's just a matter of time until you get caught out by something like this. And you never ever see it coming. It's always that, oh yeah, but this happened. Well, it's always a but this, COVID, GFC, banks, whatever the case may be, Iraq, it's always something left field. But the fundamentals, if you do it well and you've got good management behind it and good purpose behind acquisition, then you might not thrive through this time, but you will survive and hopefully be able to punch on over the other side and have good enough returns in the beginning to subsidize where you end up now.
Yeah. No, it's a good analogy, mate, in that sort of space for sure. Mate, we got a question here from David Lees, and I think it's sort of in your neck of the woods. David's talking about, can you talk to us about the US Federal Reserve? And last week announcing that it's transitioning from a hard cap of inflation to a flexible cap of inflation.
This old chestnut.
Yeah, mate. So, I'll certainly sort of, through to the keeper on that one, and hopefully you catch it. So it's your neck of the woods, certainly not mine. David asked the question. Sounds like an interesting one, mate. What do you got in that sort of space for David?
David, it's a great question. I'm just seeing whether I can find any of my old graphs that we've gone through previously. Probably give me 30 more seconds and see whether I can. Look, I probably won't. But Jace, if you can find me the 10-year Treasury graph since 50-year, 10-year Treasury graph, and it'll be a graph that goes high on the left-hand side, down to low on the right. And we can bring that up on screen and hopefully illustrate a good point. So inflation's been the target for Federal Reserve since currencies floated. Inflation has been a target that they have used in order to be able to monitor monetary policy and be able to control monetary policy. And monetary policy is just a fancy word for the Federal Reserve or the Reserve Bank of Australia putting money in or taking money out of the economy in order to stimulate by putting money in, or being able to contract it by pulling money out. And generally by putting money into the economy, what it does is it drives the economy, and then you end up with things becoming more expensive and inflation taking off, real estate doing better, shares doing better, all of these things by putting money into the economy. When you pull the money back out, you're contracting the economy, which ultimately puts the brakes on. It's going, look, we're growing too fast. And here's the thing, economies are exactly the same as small to medium businesses. When small to medium businesses grow too quickly, they blow themselves up. Dramatically. Thanks, Jace. And so as you can see here, from 1985, or it was really 82, where the sort of peak was, shortly after I was born, the world went into decline. I think it's
Andy Fenton's born. It's over. It's over.
had a little bit of a good period, but so what we've seen here is, so Treasury yields basically the 10-year Treasury yield is where governments, in this case in the US, lent money at 14%. Once upon a time when I was born, they lent money at 14% for 10 years. And they had to pay that back over a period of time. So over this period of time, you can see that for the last 40 years, basically, all that Treasury yields have done has decreased. So money has become cheaper and cheaper and cheaper and cheaper. So the Fed used to come in and out of the market in order to be able to try and curb the growth of the economy so it didn't grow too quick and blow itself up, right? And inject money in the GFC and inject money during COVID so that the economy didn't stall. Because if the economy stalls, like, that's bad. The economy can take off and kind of blow itself up and it's not too bad. But when an economy stops, like that's disaster scenario. But here's the thing. When you get down to $0 interest or a 0% interest rate, or potentially a negative interest rate, which is horseshit and it doesn't work, then your ability to intervene in and out of the monetary market ceases. right? But also what it does is it also puts a natural cap on the possibility of inflation, because you can't reduce interest rates in order to stimulate growth. It's just not going to happen. And so when you have a policy that says you need to target an inflationary rate, especially in times like this, it can be a false measure, right? Because when interest rates are so low, well, in Australia, it used to be 4% that we target. Now, if we want to hit a 4% inflation rate, which is, let's just call it growth, and interest rates are at zero, well, is that a fair comparison to trying to hit an inflation rate of 4% when interest rates were 7%? So I don't know if I've done a good job of explaining it, but relatively, we now have nowhere to go from an interest rate perspective. So what that does is it takes one of the equations out, right? So where you used to be able to factor
no ability to stimulate whatsoever.
Well, no ability to make money cheaper, right?
Yeah.
Unless you start giving it away and paying people to take it, right? And that's just not going to happen. In a way, it sort of already is. So the basically what they're doing is they're going, well, and this is my opinion, I believe that they're probably going to say, you know, maybe we should stop targeting inflation as a measure of where the economy is at and whether we should be intervening or not. And it's a really contentious, and it's also quite a technical kind of argument about Keynesian economics, but we've been using the same economic theorem, right, since before I was born.
Long time. Now we're in a period. It's the same argument. Same argument about GDP, right? So it was a one-dimensional mathematical equation, GDP growth, and then there was no cost equation to the GDP growth. And so the same thing here. It's like it's a very outdated, outmoded measurement system. And maybe it's not it's not a one. What do they call it? A blunt instrument. It's a hammer. Yeah. It's a blunt instrument for control and management.
And here's the thing, David, is that it hasn't worked. The economic theory that we've had in place hasn't worked. Otherwise, that graph that Jason showed you before about those declines, it wouldn't have just been like that. It would have been up, down. It would have been trending up and down, but it hasn't worked. It's just gone basically from the top to the bottom. And I think that in a market where money travels around the market and the velocity of money around the system is so much faster, we're actually going to see new economic policies. We're going to see new investment theories arise, not out of anything other than absolute need, because what they thought worked were kind of working at the time, but now we've taken out one of the key things that we could manipulate, we can't use anymore, and that's lowering interest rates. So the only thing that we can do is put more money into the system. So now we either have to reassess what we're measuring, because if we measure inflation, we're going to be pumping money into the system for a long time, which we know doesn't necessarily work. So we need to start to go, well, should we be measuring inflation? Should we be more focused on unemployment? They're going to start looking at different measures politically and from a reserve perspective as to what is actually the right thing to focus on and how do we actually stimulate the economy. The rest of the stuff is just noise, right? There's a whole lot of people going, okay, because here's the funny thing, Jace, they've gone I've forgotten the wording, but it was like 2 and a bit%. And people are like, well, what's a bit? Is it like 2.5? Is it 2.1?
2.5?
2.9 is a 30% increase right now. So like that's pretty intense. So I don't think it really answers your question, but I think it's an extraordinarily good question in that
it's a good question.
They're going to start changing the metrics that they're looking at, but they can't do it like that. And you won't see the Federal Reserve act like politicians, because they're not. They're actuaries, they're economists, mostly actuaries. If they were economists, they would just constantly get it wrong and then apologize for it. But they're a little bit more pragmatic. So
become an economist, you never have to be right. You never have to get it right, ever.
You could be an advisor to Trump.
Yeah. The more ludicrous your claims can be, the better the economist you are. Like, it doesn't matter how.
Alternative facts on this graph.
That's alternative facts. That's funny. it's interesting. The idea that there's archaic measurement systems in this process is really interesting, because is sitting in that meeting the other day. We started with I was sitting in that meeting with those fund managers, basically managing $1 billion of private money, and they were like, listen, like, basically, Andy, they had a platform, a fintech platform, that they avoided business to consumer lending, but business to business lending, which is outside the Australian consumer credit protection laws and stuff like that. Business to business lending, they said, well, in 24 hours, our fintech platform, we can lend up to $25 million to a business. And speaking to the speed of what you're talking about, and one of the values, you're talking about, we mentioned this last week, why is it the domain of banks lending money, which is the best, one of the simplest investment vehicles, ever invented, right? Why is it their domain? And I think into the future, Andy, it's going to not be their domain, because, right now, technology plus money is going to mean speed, which you mentioned a moment ago, speed of exchange, speed of value, speed of analysis, speed of analyzing risk for return. It's a really interesting mind melding idea. Yeah.
But I'm all over it, because this was 10 years ago, 15 years ago. This is when I was thinking about becoming an economist. This is what my thesis was about. It was about the velocity of money and how that affects debt, how that affects inflation, how that affects the monetary. Because my theory was that most people would actually have 50% of their annual income as a standard debt level. So if you're earning $100,000 a year, your nominal base, so your $0 was going to be 50,000. So if you had $0 in the bank, right, that would be the equivalent of having $50,000 in debt. And the theory was that because the money flowing around the system happens so much faster, that it allows us to actually operate with a higher debt level. And this was based off a whole lot of probably alcohol at the time, but and maybe a little bit of wisdom. But so here's the thing, and maybe we're running out of time to go through it for this week. But if we talk about risk from the perspective of the risk of losing money, right? One thing that we need to take into consideration is inflation. Right? So inflation, for those of you who don't fully get what inflation is I always relate it to when I was young. I used to get on a bike and my nana would say, can you go down and get some milk? I can say it now because she's not going to get arrested for it. She'd go, can you get me a packet of Winnie Blues? So I knew what cigarettes
my mum used to do that. Coke and Winnie Blues up the servo. Yep.
Yeah. So I'd pedal down and I'd go and I'd get a pint of milk, which it was back then. That's how old I am. And I'd get a packet of Winnie Blues, and it was $3.50. Right. So when we talk about the inflation effect, so this is Andy, handsome man, very, very handsome, big muscles. Right, these are the big muscles here. Not to be.
You have to move it up, mate. We can't see it because of your handsome face. There you go.
Not to be misconstrued as boobs. Those are muscles. Those are biceps. All right. So there's Andy, happy as Larry, happy as Jason. All right. Trundled down the street and bought a packet of Winnie Blues, and it cost him $3.50. And that's a packet of Winnie Blues. All right, and a pint of milk. So fast forward.
Your drawings are pretty good, mate. Way better than mine.
But they've come a long way, but they're still not much better than finger painting, really. It's terrible. I really shouldn't do this stuff live.
No,
so
I get it.
Nowadays, what does a packet of Winnie Blues and a litre of milk, which doesn't come in looks a little bit more like a penis, really, doesn't it? But that's,
I think
that's
you need to draw that one in. All right, we've had too much to drink right now.
all right. So I can't draw a pint of milk, so that's a pint of milk. All right.
Yes.
So how much is that now? I reckon that's about $60.
Yeah. Well, isn't it 65? Isn't it $55 for a packet of smokes and
about $5.
$5
But here, back here, that was 20 cents.
Yes.
So inflation is this idea that goods become more expensive over time. All right. So, and inflation, or CPI, is the fact that housing, milk, freaking air becomes more expensive over time. So inflation is something that keeps on. You can have times of deflation, and Brazil and Thailand have seen times of deflation where everything goes down for a long period of time and everything starts to cost less and less, right? And that's hell. We don't want to be in that period of time. So if inflation's running at 3%, every year things are becoming more and more expensive. So here's the thing. When we look at a risk return matrix, once upon a time, you looked at this. You went, so you've got equities, and you got property, and you got cash or fixed interest. I'll call it FI, right? Fixed interest. And equities, pretty standard, on average, 8-9% over a long period of time. Property, not too dissimilar, right, over time. So if you invest in these, because these are longer term investments, when you invest in these suckers, you're looking for 5 to 7 years minimum, right? Minimum sort of time horizon. So when we do the equation and we go, well, what's the risk? Okay, well, we will have capital fluctuation, but let's say we're on the lower side of the equation. In equities, we're looking at about 5%. In property, we'll look at about 5%. And of course, the journey might be really erratic, or the journey might be a little bit less erratic. But right now we've got cash and we're basically getting 0 point something %, which means that you absolutely guarantee a 2.5 something % loss every single year by holding it.
Yeah.
2.5%, that's if inflation's running at 3%, 2.5% guaranteed every year. So it starts to flip that whole, and perhaps we'll chat about the 60-40 thing on it next week. But when you consider that you're guaranteed to lose money by putting it into cash, guaranteed. So does that mean it's a safe asset? Well, it's only a safe asset if you believe that the wheels are going to fall off and the whole world is going to start to become a whole lot cheaper.
What's the definition of safe, hey? So, I've said this a million times to people in the world of property. It's like, if it all melts down and, every property in Melbourne drops 50, 60%, well, so what? Like the whole system's in trouble. The whole system's in trouble. So, but you know what? You know what's more likely? It'll drop 5% on average, but the good properties will go up 20%. And then in 3 years' time, you're going to get the bounce, and you're going to go up another 10 or 15%, So that's what's more likely. But the really unlikely, if it did happen, well, everyone's in the same boat anyway, and it'll be a disaster of epic proportions. So who cares? Like at the end of the day,
And the other thing is that when they print money, it generally causes inflation.
Yes.
To some sort of a degree. And so at least it's putting more money in there. When people aren't spending it, then it doesn't cause the inflation. But when people do spend it, it does tend to cause inflation. Like we were talking about earlier on about the building subsidies and that arbitrage of, you get a discount from the government, so the builders raise their price and those sorts of things. So the market arbitrages really quickly. So I think that having, spurred on from David's extraordinarily good question, and that one's going to play out for a long time to come. That's not a 1 year question. That's a decade question.
Decade question. Yeah, because governments need to they need to change the way they rationalize the economy, or their decisions, and reserve banks and so on. I don't know. Quick pop quiz. Which Bank of Australia, Andy? Which Bank of Australia used to be the Reserve Bank of Australia?
Commonwealth Bank.
Hey, you're on it. There you go. 1936, I think they split. Reserve Bank went that way, and interesting times. Anyway, mate, yes.
That's what we were meant to talk about this week.
It was. Anyway, we've got 22 seconds left. No, maybe we'll put that. We might put a pin in that one, because it's interesting. The securitized lending and the fractional lending system. Where banks are only required to hold, on average, about 10% of the actual capital that they've lent to people, and it goes around and around in the world, and then hey, we need more money. All right, well, Reserve Bank or central bank, please print some more money. Central bank needs to buy, I don't know, usually government bonds. Sometimes it lends money directly to banks, and so on. So it's, if you sort of step away and just observe it, it can be very interesting. But for some in the world of social, they get a bit conspiracy and, the world ending about the whole thing. But anyway, it's an interesting one, Andy. But mate, I think we should leave it there. It's been Alison got it too. CBA used to be the Reserve Bank, so we might leave it there for this week. Been a great chat, mate. It's awesome. I think doing a little bit of what's in the news and a little bit of pontification at the end is not a bad way to roll with wine and wisdom, mate. But thanks everyone for dialing in. There was sort of a good chunk of you guys stay on for the whole night, so appreciate your support, appreciate your questions, appreciate your shout outs, and for all of those who are still on tonight, still on right now, enjoy the rest of your weekend. Have a great one, and hopefully see you guys next week. There's Brian. Hey, Brian, how are you, mate? Anyway, there you go, Andy. Done and dusted. Another wine and wisdom, mate. As always, very informative. And I'm pumped, Andy. I need you to help me set up a direct account, and I'm going to be investing in Apple and Tesla as soon as I can. All right, everyone, stay tuned for that one.
When it's good. When it's good.
That's down, mate. I'm buying. I'm in. All right, gang. Take care. Have a great weekend. Thanks, Andy. All right. Take care, everyone. Bye-bye.
See ya.